Hello and welcome to our second Oz Trader Chat, the Trader Chat which is designed for people in or near Australia in terms of the time zone. In today's Trader Chat, we will be speaking a little more about the Australian market, and we're going to be continuing the discussion that we started last week. Before we do that, I need to run through our legally required disclaimers. The first thing that you should understand is that all trading involves risk. Please be aware of and accept risk before trading, and never trade with money that you cannot afford to lose. You should also know that past performance of any trading methodology is no guarantee of future results. And no representation is being made in this webinar that any account will achieve profits or losses similar to those discussed. Finally, our hypothetical disclaimer tells us that all results should be considered to be hypothetical unless otherwise specified, and hypothetical performance results have many inherent limitations and, unlike an actual performance record, do not represent actual trading. Okay, there we go. Those are our legally obliged disclaimers. A few pointers about using NetViewer, the software that we use for these trader chats. The first thing you should understand is that the best way to ask questions is to type a message into the chat window. I think most of you have discovered the chat window already. If you cannot hear me, slide your speaker slider up in the VoIP tray in the NetViewer control panel. If you'd like to talk to me, and it's been a very long time since anybody did do this, but if you want to, then right-click and also enter a chat message. Speaking of which, please be careful of mouse clicks because they pop up brightly colored arrows and chat windows, which can be a little distracting. All right, so let's get straight down to it. I particularly enjoyed these Oz Trader Chats because they're a little less formal, if you like, than our Wednesday Trader Chats, because they're targeted at a smaller group, and the idea of breaking our Trader Chats into smaller groups is that we can focus our discussion a little more closely on the people that are there in the Trader Chat. So in last week's Oz Trader Chat, I introduced Sentient Trader to those of you who weren't familiar with it, and I discussed an analysis on the Australian stock market index, the ASX. It's called the S&P ASX, for those of you who don't have the data for it, and we had a discussion about performing an analysis of that Australian stock market index. Let's just do a very quick sort of reminder of what we did last week, particularly for those of you who missed out on last week's discussion. The discussion I hope today you're going to find is not only going to be applicable to people living in Australia. I know that I see several people there who aren't in Australia, of course, and so I hope that you're going to find the discussion applicable generally to markets around the world. As a South African, I spent many years, of course, living in and trading in South Africa, and I found it very interesting how the South African stock market shed light on what was happening in the American market, and vice versa. Of course, I would look at the American market and take my lead often from what was happening in the American market for my trading in South Africa. And I believe the same thing applies to Australia, or wherever you are in the world. I think it's very useful to take a look at different markets around the world. Let's remind ourselves what we spoke about last week. The first thing that I did was that I accessed data for the Australian stock market index, the ASX. I did that through Google using ASCII data, but of course you can source data from a wide variety of different places. And the first thing I did was I automatically just performed a default analysis. And the results of that default analysis, let me just quickly show you here, are shown on this on this chart here. Of course, Sentient Trader performs an analysis according to Hurst cyclic principles. So we're talking about the cycles that are moving the market, and those cycles are being presented at the moment at the bottom of the chart by means of those semicircles. All right, so when a semicircle is moving up, that indicates that a particular cycle is causing prices to move up, and when a semicircle is moving down, it indicates that the cycle is influencing prices to move down. This is the default analysis that Sentient Trader ran when I simply pressed the green Analyze Now button. And as you all know from last week's discussion, it placed a 4.5-year cycle trough back in 2003. There, that is over there, and then another one in August of 2007, and the most recent 4.5-year cycle trough it placed in August of 2011. Now, you might remember, if you were here last week, that I discussed that and considered that we could in fact get a better analysis, which I did, and I created another chart where there we go. I shifted the 54-month cycle, and so here is, in my opinion, a better analysis, in that it positions a 4.5-year cycle trough early in 2009, March 2009, and that presents us with a better overall picture in terms of what I believe is happening in the Australian stock market at the moment. And it ties in more closely with what's happening in international markets. You will know if you are in Australia, or I see we've got people from France and Russia with us today. So you will know if you're trading in a country that's not America, that although it's very important to keep a close eye, obviously, on what is happening in America, one needs to analyze the market in the country in which one is trading. And there tends to be a lot of commonality between markets. And if you have an analysis that differs markedly from the analysis for what's happening in America, then you need to consider adjusting that analysis so that the pictures fall in line with one another. I'm not necessarily saying that the US markets lead international markets, but certainly your analysis of your market, pretty much wherever you are, needs to have some commonality with what's happening in America. So this analysis, I believe, is a better one. We went on further to refine this analysis because of the very strong, very volatile day that we spent a bit of time speaking about last week, the day of the 9th of August 2011, which was a very volatile day in Australia. I spent some time speaking about that last week, and I pointed out that that single day pushed prices down to form a low price, which Sentient Trader has marked as a trough of the 18-month cycle. I believe that was what Hurst described as fundamental interaction, which means that fundamental events caused a bit of a panic for a moment in Australia. Prices dropped down and then bounced straight up again, and that in fact the major trough of 18-month significance is inappropriately positioned there on the 9th of August. And so I very simply managed to shift that trough, and here in this analysis you will see that trough is, I believe, more correctly positioned on the 4th of October of 2011. All right, so here we are with the analysis, which I believe is playing out in the Australian markets. If you have any questions or any of your own opinions, I'd love to hear about them and discuss them. This is what I think is happening in the Australian markets at the moment, and it echoes very closely what's happening in international markets. So let's spend a little time just updating ourselves about the analysis, and then I'm going to spend the rest of today's Trader Chat talking about how one makes trading decisions on the basis of the analysis that has been performed. You'll know there are two versions of Sentient Trader. There is the Analyst Edition and the Trader Edition. The Trader Edition of Sentient Trader performs the analysis and generates trading instructions. In other words, it will tell us buy or sell at a particular level. It's very important, even if you are using the trader edition of Sentient Trader, that you understand those trading instructions. And so that's what we're going to spend some time speaking about today. All right, so let's take a look at this analysis. This is the analysis that I believe is playing out. First of all, well, let's just zoom all the way out and speak about a few things. First of all, as I have touched on already this morning, the 4.5-year cycle, according to this analysis, experienced a trough in March of 2009, which I believe is pretty much what happened. There are various different opinions about that very deep trough early of 2009. Some people believe that in fact that should not be given 4.5-year significance, that it was not as significant as 4.5 years. Other people believe that it was a 9-year trough that occurred then. I believe there's a possibility there might be a 6-year cycle that came into play. But to keep things simple, I believe that the placement of a 4.5-year cycle trough there is appropriate. Okay. Bear in mind, it's something that I keep repeating, and I've been repeating it quite a lot recently, that what's important when you're about to make trading decisions using Hurst cyclic principles, what's important is the analysis in terms of what it tells you about what's going to happen tomorrow or over the next month, rather than what happened 5 years ago. Many people, when they look at this analysis, would question the 4.5-year cycle trough way back here in August of 2004. And yes, you'd be right to question that. There are, it's a very poor trough placement for a very major trough of 4.5-year significance. However, when we're making trading decisions today for what's going to happen in the market over the next 40 days or so, I believe that the positioning of the phasing, 7 or 8 years ago, I think that's not really of any great significance. There is a very big question that I think is looming in Hurst cyclic analysis circles, if you like, which is how do we resolve the very deep trough in 2003 and the very deep trough in 2009? That is a 6-year gap there. Let me just clear this, and we can actually measure it. So the distance between those two troughs is 72 months, okay, which is 6 years. And 6 years is, of course, not a Hurst cycle. You will know that Hurst cyclic analysis is performed on the basis of what is called a nominal model.